And so before we move on to sort of the second half of this lecture, which is talking about risk, let's finish by talking about the different types of bonds, or sort of the most common different types of bonds. And I think this is an important thing to talk about simply because these are bonds that you will, if you will go work in the finance space, if you're reading financial news, if you're watching TV, these are kind of things that you might hear about. Okay, certainly this is not the total universe of types of bonds, because a bond is a contract, and so we can write anything into a contract that we want as long as it's legally enforceable, and that means that there are essentially an infinite number of types of bonds. These are simply the most common ones with the most common covenants in them that change up the way that the bonds operate. Okay? So the first is called a zero coupon bond. And this is actually a very common type of bond because it's the most common way for a government bond to work. And again, finance is not super clever about naming, so the name usually gives away the function. A zero coupon bond is a bond that pays no coupon payments. That does not mean it doesn't pay interest. The way a zero coupon bond works is that you loan the company or the government less money than they pay you back, right? So it's still typically built around the $1,000 par value. But for instance, if you were going to get 10% interest rate from the government, you might loan the government $990, and then they would pay you back $1,000. Right? I didn't do the math right. I just made that up. But you would loan the government less than $1,000. They would pay you back your $1,000. So they would pay you back what you loaned them plus all your interest in one lump sum. That's what a zero coupon bond is. We talked about callable bonds. These are bonds that can be paid off early. There's also a way smaller subsection that is similar called a puttable bond. And this is not something companies really like to do, but a puttable bond is a bond that can be forced on the company early. Meaning, if you're the lender, you can call the company up and say, listen, you have to pay your loan off early, right? Which is not a kind of a loan that any of us would want to take out. It's not the kind of a loan that any general company wants to take out, so they're not as common, but they do exist. Municipal bonds are bonds that are issued by municipalities in the US, where a municipality is a type of local government structure. So these are bonds issued by small city, state, county level local governments in the US, so distinguished from a federal bond, which would be issued by the US government, the central government. Right? So a municipal bond would be issued, for instance, by, say, the city of Boone or the county of Watauga or the county hospital, or by a local entity like ASU. Right? So App issues bonds to raise money to, say, build a new dorm. That would be a municipal bond. If the county hospital wants to build a new building or expand its intensive care unit, it would issue a municipal bond as a way to raise money. If the city of Boone wants to redo King Street and repave it and put bridges over it so that people don't have to do the crosswalks or something like that, they might be able to raise money using a municipal bond. Okay, so these are local government bonds. Now they have one sort of very specific benefit, which is why we bring them up. And that very specific benefit is that the interest received from a municipal bond is not taxable at the federal level. So if you loan money to the Watauga County Hospital by buying one of their bonds, the interest payments that you receive is not taxable as federal income. It would only be taxable as North Carolina income, okay, which is a valuable thing. The tax rate on that income at the federal level could be 20-25%. And if you don't have to pay it, then that's a valuable thing to an investor. And so it makes it easier. It's intended to make it easier for these local governments to raise money by providing this tax advantage. It is such a great tax advantage that it's a huge source of money, a huge source of income for the very wealthy, and a big way for them to store money, because they can put a bunch of money into relatively safe investments that pay a relatively small rate of interest, but that rate of interest is not taxable at the federal level, at least. And so municipal bonds in places where there is no additional state income tax, like Florida or Wyoming or Texas, have the advantage of their interest being tax-free. There is no federal tax and no state tax on that income. And so municipal bonds sold by, say, the city of Dallas in Texas would essentially be tax-free. The income on those bonds would be tax-free, which is, again, that's a significant advantage. And so it does make investors that are trying to reduce their taxes eager to participate in the municipal bond market. Okay? It is one of the biggest markets in the world, the municipal bond market in the US. Now, junk bonds. Well, there's two things that you should know about them. One is that they're junk, and the reason that they're junk is because these are bonds sold by the very riskiest firms, the most risky firms. Okay? So a junk bond is one that is expected to default with a greater than 50% chance in the next year. Okay? Where default is the legal word, meaning they don't pay the interest on their loan, meaning they fail to pay the loan back, and we can take them to bankruptcy court. Okay? That's why they're called junk. They're very risky. They're 50% chance of failure to pay in the next year. Because of that, they offer a very high yield. They offer a very high coupon rate. Sometimes you'll see junk bonds offering rates of 20, 25% on their loan, which of course makes it even harder for that company to pay it back, and even more likely that it's going to fail, right? It's a sort of a death spiral. If you get into a financial position where you're forced to take out a loan when you're already in trouble, it's going to be at terms that are going to make it even worse on you. Now, the second interesting thing about junk bonds is, for those of you that are marketing majors, this is one of the sort of greatest brand rebrandings that I think has ever really happened, because the junk bonds are no longer really referred to as junk bonds, particularly in the media. They're now called high yield bonds. They're called high yield bonds because, of course, they pay a high yield to justify that they're the risk that you're undertaking. They are still junk. There has just been a massive, massive marketing campaign to rename them from what we call junk in the 80s and 90s to what we call high yield bonds now. And it has been remarkably successful. Again, particularly in the media, stopped referring to these bonds as junk bonds. And nothing about them changed. In fact, because they are no longer called junk bonds, the trading in these bonds and the people willing to buy these bonds has exploded. So once they stopped calling them junk and started calling them high yield, the market size expanded by more than 10 times. Because people want high yield. They want to earn a really high return. And people are really bad at thinking about risk. They are not good at understanding the second fundamental rule of finance, which we're going to talk about on the next slide. And that is that risk and return trade-off. If you are getting a high return, it is because you're taking a high risk. So just sort of an interesting aside about a really sort of unusual rebranding effort that you might not think about. I still think they're junk, and I still call them junk. And I would encourage you not to get sucked in by the new name. Okay. Floating rate bonds. These are bonds that have an interest rate that changes with the market rate. So the coupon rate of these bonds is set to be the market rate plus 2%. And so if the market rate goes up, then the coupon rate of the bond goes up. If the market rate falls, the coupon rate of the bond falls. There's usually some sort of graduated steps that has to happen, but essentially that's what happens, is the rate moves up and down with the market rate. And that might seem appealing. There are personal finance level equivalent. They're called adjustable rate loans. You can get an adjustable rate car loan. You can get an adjustable rate mortgage, sometimes called an ARM. The problem with these, particularly for the borrower, is that rates are usually going up when times are bad and are usually falling when times are good. And what that means is that when you have an adjustable rate mortgage, the rate is climbing when the economy is at its worst. And so it makes it much more likely that people are defaulting on their loans because the loan is getting harder to pay off when the economy is souring, people are losing their jobs, or maybe taking pay cuts or things like that. Okay? So for companies, it's not as big a deal. But so you see there's a lot, these floating rate bonds for companies. This isn't a personal finance class, but unless you know what you're doing, I strongly encourage you not to ever take out an adjustable rate car or house loan because it's not in your best interest, even though it may be marketed that way. Okay, they are usually marketed to you as being lower than having a lower rate than whatever the conventional rate would be at the time. But that is, of course, only because they know it's going to go up when everything goes to hell. Okay. Convertible bonds, these are more and more common. A convertible bond is a bond that can convert into something else. It typically converts into equity. Okay. So we'll talk a little bit more about bonds, but the sort of biggest downside to a bondholder is that you have made a loan to a company, but you have no say in the running of that company once you've made them a loan. So you have a big risk exposure, which is the company doesn't pay you back the money that they owe you. And you have no way to curtail the risk that the company might take because you have no vote in the firm. So a convertible bond is usually structured so that you can change your loan into equity shares. So you can say the bond will convert into 10 equity shares. And so it's usually triggered by something, some bad behavior that you don't want to happen. So the contract will say something like this bond can be converted if the company has 2 quarters of negative net income, so it's losing money. Then the bondholders can convert into equity holders some of their bond holdings into equity. They can then vote out the management team and take over the firm, essentially. Right? So that's typically how convertible bonds are supposed to work. They can convert into lots of different things. Warren Buffett is famously uses convertible securities as a way to lend money to companies that convert either into common shares or preferred shares, or vice versa. So they're pretty common. Like callable bonds, convertible bonds, any of these sort of special provisions, they provide additional value. And so that's why we are not going to learn to value these different kinds of bonds specifically, because with these different value provisions, the value gets harder and harder to do. It's not just time value money. Okay, income bonds are kind of interesting. I just give these as an example of the way that contracts can be used to make sort of anything that you want. Income bonds aren't allowed anymore. The IRS said they're no good. But an income bond was a bond that had a provision that said the coupon only needed to be paid if the company had a positive net income in that year. Right? So only if they were making profit did they have to pay the income. Right? And if they didn't, or did they have to pay the coupon? And if they didn't make income that year, if they lost money, then they didn't have to pay the coupon. Now, the reason the IRS doesn't like that is because bonds and debt specifically, the interest on that debt has a very advantageous tax position. I said that all wrong. The interest on debt, whether bonds or just a standard bank loan, has a tax advantage. And that is because it is treated as a business expense. Okay? So think about the income statement. Interest comes out before we pay taxes. And so the interest that we pay on our debt reduces the amount of taxes that we pay. Okay? And that's only because we treat it as an expense. So just like any other expense, like our supplies and things like that, it reduces our income and it reduces our taxes owed. The income bonds then allowed companies to skirt that, because if they weren't making money, they didn't pay the interest. And so the IRS said, well, then you can't treat interest as an expense. And so in the years when you make income, you can't use it as a tax deduction. And so that has sort of destroyed it. But again, this is just an example of the things that you can do and the things that companies try to do with different types of bonds and different provisions in their contracts to make sort of anything they want. Debt is one of the most powerful instruments in the financial toolbox. And it's simply because you can write a contract to do almost anything. And to avoid taxes or anything like that is pretty trivial.